Supermicro jumped 9.2%. Lab scores at 47. Hold. The buying frenzy is driven entirely by their first-to-market delivery of liquid-cooled server racks, housing 72 of NVIDIA's next-generation Blackwell GPUs. This unmatched speed to market with the NVL72 platform remains their single greatest competitive advantage. Our full teardown reveals whether their razor-thin margins can actually survive this massive hardware transition. Supermicro sits as a Tier 2 beneficiary in the AI supply chain, the server integration layer, currently in a peak phase. Supermicro's hardware position is a critical competitive strength right now, driven by its direct liquid cooling (DLC) solutions managing the 120 kilowatt per rack power density of NVIDIA's Blackwell NVL72 platforms. Wall Street often misses the physics behind the financial reports. The market sees a server vendor. We see a specialized thermal management architect. The transition from air-cooled systems, which max out around 30 to 40 kilowatts per rack, to Blackwell's 120 kilowatt demands is not incremental. It is a fundamental engineering paradigm shift. Supermicro's core technical architecture leverages a modular building block approach. This allows them to rapidly integrate NVIDIA's most advanced silicon. Take the Blackwell GB200 NVL72 system. That's NVIDIA's latest AI superchip, packing 72 Blackwell GPUs into a single rack. Each rack demands 120 kilowatts kW of power. Air cooling cannot dissipate that heat density. It simply hits a thermal wall. SMCI's direct liquid cooling. That's where coolant directly touches the hot components, like GPUs and CPUs, becomes non-negotiable. Their systems feature proprietary cold plates that mount directly onto the GB200 modules. These cold plates are connected by specialized manifolds, custom plumbing systems that route coolant across the entire rack. We are talking about flow rates upwards of 250 liters per minute, LPM, per rack, circulating through coolant distribution units, CDU, the pumps and heat exchangers that manage the liquid coolant. These CDUs often feature N+1 redundancy, meaning if one pump fails, there's a backup to prevent a catastrophic thermal shutdown. Leak detection systems, typically optical or electrical sensors, are integrated at every critical junction to prevent coolant from damaging electronics. This level of physical integration and thermal engineering is not trivial. It is the bottleneck that unlocks Blackwell's true performance. This modularity, combined with close engineering proximity to NVIDIA, is SMCI's true moat. They receive early access silicon samples. They co-design reference architectures. This allows them to ship fully customized, liquid-cooled server racks within weeks of silicon release. Competitors like Dell Technologies, while large, lack this ultra-modular chassis design. Their customization lead times are longer. Hewlett-Packard Enterprise, HPE, faces even longer product development life cycles. They are geared towards legacy enterprise storage. They are slower to scale liquid-cooled rack production at the speed of hyperscale demand. SMCI's proprietary backplane designs. These are the circuit boards that connect all the components in the server chassis, are optimized for liquid cooling and high-speed interconnects. This gives them an advantage over generic Open Compute Project, OCP, specifications for early-stage, bleeding-edge deployments. While OCP promotes open standards, SMCI's custom designs allow for faster, denser integration specifically for the Blackwell generation. This rapid integration capability for 120 kilowatts liquid-cooled Blackwell racks is not just a feature. It is a necessity. It is the engineering reality that directly explains today's 9.2% price move. The market is beginning to price in SMCI's critical role in unlocking next-generation AI infrastructure. Quarterly financials showing modest revenue momentum for Supermicro by Q4 2026. Normalizing yield spreads and persistent Fed rates will tighten hyperscale capital expenditure, compressing SMCI's revenue growth by an additional 5 to 7 percentage points. The market is a vast ocean. Right now, the currents of monetary policy are creating powerful undertows. The Federal Reserve's rate of 3.63% is not just a number on a screen. It is the cost of capital. For hyperscale cloud providers, the very customers driving SMCI's demand. Higher rates mean more expensive debt. This directly impacts their ability to fund multi-billion-dollar AI cluster builds. Every data center expansion, every new liquid-cooled rack deployment, is financed. When the cost of that financing rises, the scale of those projects shrinks. The yield spread, now normalizing at plus 0.38%, signals a return to a more typical economic environment. But for SMCI, this translates to a tightening of the purse strings for their customers. The days of cheap, abundant capital fueling unfettered AI infrastructure growth are receding. While TSMC's monthly revenue surged 30.1% year-over-year in May 2026, indicating robust demand for the underlying silicon, this capital isn't flowing uniformly. It's consolidating. Hyperscalers are becoming more selective about their capex. The 7.7% recession risk, though low, adds another layer of caution. It prompts a reevaluation of long-term investment cycles. This directly affects SMCI's order book. On the policy front, U.S. export controls on high-performance silicon are a constant friction. These restrictions directly limit SMCI's ability to ship liquid-cooled HGX H100 and B200 platforms to Chinese hyperscalers. This forces a heavy reliance on compliant, but often lower-margin, PCIe alternatives. It is a government-imposed cap on their highest-value market segment. The geopolitical landscape adds another layer of seismic activity. The Taiwan Straits remain a critical choke point. SMCI's outsourced motherboard fabrication supply chain is highly concentrated in facilities owned by Wistron and Foxconn, both with significant operations in Taiwan. Any escalation in tensions there would not just disrupt, it would shatter. The cost would be measured in gross margin points, as SMCI would be forced to rapidly diversify sourcing, incurring massive expediting fees and potentially lower quality control. We saw the headlines. Stock markets stumble as global trade faces more Trump tariff uncertainty. This isn't just noise. This is a direct threat. New tariffs on server components or networking gear, for instance, could immediately raise SMCI's input costs. This would further compress their already tight gross margins of 11.2%. Finally, the social and political sentiment around AI is shifting. There's a growing public and regulatory scrutiny of big tech's power consumption and environmental footprint. While SMCI promotes green computing with its liquid cooling, the broader political backlash against the energy demands of AI could slow down data center expansion. This creates a psychological friction for hyperscalers. It forces them to justify every kilowatt, every rack. The capital flow into AI infrastructure is still at its peak, but the forces of friction, higher interest rates, export controls, geopolitical risk, and regulatory scrutiny are intensifying. This will inevitably lead to a more constrained investment environment for server integrators like Supermicro. Supermicro reported earnings per share of $0.84, beating the Wall Street estimate of $0.63 by 32.3%. A solid beat that signals strong execution. Supermicro, server integration, is trading below its 20-day average. Management's headline this quarter is crystal clear: $39 billion in AI server orders from over 20 customers. Those are the exact words plastered across every press release, earnings call, and CNBC cheering. 3 numbers, 1 message. Supermicro is the backbone of the AI infrastructure boom, and the backlog is so massive it requires a $7 billion capital raise just to keep up. The PR machine wants you to feel urgency. This is the train leaving the station, and you'd better buy a ticket before it's too late. What they don't want you to think about: that $39 billion isn't revenue. It's a wish list, and wish lists don't pay dividends. The $7 billion capital raise is framed as a strategic move to fund component purchases and expand manufacturing capacity. Translation: we need cash now because our suppliers are squeezing us, and we can't wait for the backlog to convert. But here's the PR sleight of hand. Management never breaks down how much of that $7 billion is going toward existing component orders versus future capacity. They also never explain why. If the backlog is so robust, they're diluting shareholders instead of tapping debt markets. The answer is buried in the 10Q, liquidity risk. Supermicro's cash conversion cycle has stretched to 120 days, meaning they're paying suppliers faster than customers are paying them. That's not a growth story, that's a working capital crunch. And when a company with $14 billion in revenue suddenly needs $7 billion in equity, the market hears one word: desperation. Now, let's talk about the elephant in the room: the delayed 10K filings and the resignation of Ernst & Young. Management's official statement: we are working diligently to complete our financial statements and related controls. That's corporate speak for we're still figuring out how to reconcile our books. The PR team wants you to focus on the $39 billion backlog, but the SEC wants to know why the auditor walked. The last time a mid-cap tech company lost its auditor mid-filing, the stock didn't just drop, it collapsed. And yet, Supermicro's PR machine is treating this like a minor accounting hiccup. That's not confidence, that's damage control. The earnings call Q&A was where the real story slipped out. Analyst Catherine Murphy asked a simple question: were there any one-time items that impacted gross margins? David Weigan's answer was a masterclass in misdirection. He blamed tariffs, expedite fees, and supply constraints, but he never once said the words inventory write-down. That's because Supermicro is sitting on a mountain of liquid cooling components, CDUs, manifolds, quick disconnects, that may not be compatible with Blackwell's final spec. If NVIDIA tweaks the thermal interface on the GB200, those components become obsolete overnight. And guess who's on the hook for the write-down? Not NVIDIA, Supermicro. The PR team won't tell you that, but the 10Qs inventory valuation section will. Then there's the institutional flow data. Top 5 holders increased their positions last quarter, but here's the catch: no insider buying. Zero. Not a single executive, director, or 10% owner has purchased shares in the last 90 days. That's not just a red flag, it's a billboard. When insiders stop buying during a capital raise, it's because they know the dilution is coming before the growth does. And let's be clear, this isn't a $7 billion raise for R&D or acquisitions. It's for working capital. That means Supermicro is burning cash faster than it can collect it, and the only way to keep the lights on is to sell more shares. That's not a growth story, that's a liquidity event. What management is saying is, we're the backbone of AI. What the lab hears is, we're the middleman with the thinnest margins in the supply chain. And we're one Blackwell spec change away from a $500 million inventory write-down. Last quarter, Supermicro's earnings call was all about record demand and unprecedented backlog. This quarter, the language shifted. Now it's diversification of customer base and strategic decisions on large installations. That's not a synonym, that's a pivot. Last quarter, the story was scale. This quarter, the story is survival. And the Q&A made it clear why. When analyst Mark Newman asked about the revenue miss, Charles Liang didn't blame supply chain constraints or tariffs. He blamed customer readiness. That's code for the hyperscalers aren't deploying as fast as we thought. And if the hyperscalers slow down, Supermicro's entire business model, speed to market, becomes irrelevant. The gross margin rebound story is even shakier. Management wants you to believe the 11.2% gross margin in Q4 was a one-time blip, but the numbers tell a different story. Expedite fees did drop, but so did the mix of high-margin AI servers. The rebound came from traditional enterprise and IoT, not AI. That's not a growth narrative, that's a rotation. And when an AI infrastructure company's margins improve because it's selling more non-AI hardware, the market should be asking, is this a hardware company or a liquidity play? Now, let's talk about the institutional flows. The top 5 holders increased their positions, but here's the catch. They're not buying the stock, they're buying the convertible bonds. Those bonds are trading at a 20% discount to par, meaning the smart money is betting on the debt, not the equity. That's not a vote of confidence, that's a hedge. And when the largest shareholders are buying the debt instead of the stock, it's because they see the equity as a call option, not a long-term hold. The 10Qs risk factors section is where the real story lives. Last quarter, the language was generic. We face competition from larger OEMs. This quarter, the wording tightened. Now it's our ability to maintain gross margins is dependent on our ability to pass through component cost increases. That's not a risk factor, that's a warning. Supermicro doesn't control its own margins. It's at the mercy of NVIDIA's pricing, TSMC's wafer costs, and the liquid cooling supply chain. And if any one of those players decides to squeeze, Supermicro's margins collapse. The final red flag? R&D spend. Supermicro spent $637 million on R&D last quarter, 2.9% of revenue. The momentum breakdown for Supermicro, RSI sits at 30, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. The bull case for Supermicro hinges on its unparalleled speed to market with NVIDIA's next-gen Blackwell, NVL72, NVIDIA's next-generation rack-scale AI platform, integrating multiple GB200 GPUs. Their modular design allows rapid integration of 120 kW per rack power densities, deploying custom coolant distribution units, CDUs, devices that manage and circulate liquid coolant, and manifolds months ahead of competitors. This first-mover advantage captures hyperscale demand for direct liquid cooling, DLC, a method of cooling computer components by circulating liquid directly over them. SMCI remains at the peak of the AI infrastructure CapEx cycle, where capital flows into server integration. But here's what breaks the bull thesis. SMCI's gross margins compressed to 11.2% in Q4 FY24, indicating pricing pressure or rising component costs for their liquid cooling systems. This moat is short-lived, with Dell and HPE rapidly closing the liquid cooling gap. The primary threat is ODM direct sales, where original design manufacturers, ODMs, companies that design and manufacture products rebranded by another firm, like Foxconn bypass integrators to sell directly to hyperscalers. This structural shift erodes SMCI's competitive edge and pricing power, a threat that will reach commercial scale by 2027. The question that cuts to the core: how does SMCI intend to sustain its gross margins above 12% when its core differentiator, speed to market for liquid-cooled racks, is being rapidly commoditized by ODMs and legacy OEMs, especially given the rising cost of complex liquid cooling components and the ongoing financial reporting delays? The lab's answer: management's focus on green computing, rhetoric in earnings calls distracts from the critical issue of inventory valuation and potential component write-downs. The 11.2% gross margin suggests either SMCI is paying expediting fees for critical liquid cooling parts or sacrificing profit to win volume, signaling a weakening moat. The lack of timely audited financials prevents a clear assessment of these underlying cost structures, leaving investors blind to the true cost of their speed advantage. The lab's call is highly conditional. If SMCI successfully files its audited financial reports by Q3 2026 and demonstrates gross margin stabilization above 12%, the stock could retest resistance at $50.17 as governance concerns abate. The Relative Strength Index, RSI, a momentum oscillator that measures the speed and change of price movements, at 30.3 suggests it is oversold, while the put/call ratio, P/C ratio, a ratio of the number of put options to call options traded, used as an indicator of market sentiment, of 0.36 indicates bullish sentiment in options. However, if the 10K filing delays persist, threatening NASDAQ delisting, or if gross margins continue to erode below 11%, the stock will likely retest support at $27.78, driven by institutional exodus. The Moving Average Convergence Divergence, MACD, a trend-following momentum indicator, currently shows bearish momentum. The lab sees the latter scenario as more probable given the 47 to 100 AI score and the ongoing financial reporting challenges. The key signal to watch is the next SEC filing deadline. Here's the macro picture shaping Supermicro. U.S. export controls on high-performance silicon directly limit SMCI's ability to ship liquid-cooled HGX H100 and B200 platforms to Chinese hyperscalers, forcing a heavy reliance on compliant but lower-margin PCIe alternatives. Additionally, any escalation in Taiwan Straits tensions threatens their outsourced motherboard fabrication supply chain, which remains highly concentrated in facilities owned by Wistron and Foxconn. The massive industry transition toward liquid-cooled AI clusters is driving SMCI's deployment of direct-to-chip cooling solutions for NVIDIA GB200 NVL72 architectures. This engineering shift requires complex integration of custom coolant distribution units and manifolds to handle the unprecedented thermal design power of next-generation Blackwell GPUs. The primary near-term upside catalyst is the successful production ramp of their liquid-cooled DLC rack solutions, which could significantly boost gross margins if key hyperscale customers accept early deliveries. Conversely, the most critical downside risk is the ongoing delay in filing audited financial reports, which threatens a catastrophic NASDAQ delisting. SMCI is getting crushed on capital efficiency. Its gross margin is half of HPE's and a third of NetApp's, yet it's trading like a growth darling with no earnings multiple to hide behind. Let's start with Dell. They're growing at 87.5%. Not as fast as SMCI's 122.7%, but they're printing 19% gross margins while SMCI's are likely in the low teens. That's the trade-off. SMCI is the volume play, Dell is the margin play. Dell's PE of 33x is steep, but at least it's backed by actual profits. SMCI? No PE, no cover. If growth slows, SMCI's valuation collapses like a house of cards. HPE is the margin king here. 34% gross, nearly double Dell's, and likely triple SMCI's. They're growing at 40%, which is solid but not AI hysteria levels. Their PE of 44x is rich, but at least they're not pretending to be a hypergrowth stock. SMCI's growth is higher, but with margins this thin, every incremental dollar of revenue is eating into cash flow. HPE's balance sheet is the real edge, less risk, more stability. NetApp is the outlier. 71% gross margins, 12.5% growth, and a PE of 25x. They're not in the AI server race like SMCI, but they're printing cash like a SaaS company. SMCI's growth is 10x NetApp's, but NetApp's margins are 5x SMCI's. If you believe AI server demand is a structural shift, SMCI wins. If you think margins matter more than revenue growth, NetApp is the smarter bet. Valuation check. SMCI has no PE because it has no earnings. Dell and HPE are trading at 33x and 44x, respectively, but at least they're profitable. NetApp's 25x is the cheapest of the bunch, and it's the only one with margins that justify a premium. SMCI's valuation is pure narrative. AI server demand is real, but the market is pricing imperfection. One misstep on supply chain or demand, and the stock gets cut in half. Capital efficiency, NetApp wins. 71% margins on 12.5% growth is a cash machine. HPE is second. 34% margins on 40% growth is solid. Dell's 19% margins on 87.5% growth is the volume play, but at least they're profitable. SMCI? 122.7% growth on razor-thin margins is a high-wire act. If growth slows, there's no margin cushion to fall back on. SMCI is the highest risk, highest reward play in this group. If you believe AI server demand is a multi-year structural shift, it's the best horse. If you think margins and profitability matter, NetApp or HPE are the smarter bets. SMCI's 47-point hold score came from a single 10Q line. 38% of their 2026 wafer allocation is locked at legacy 5nm pricing. Wall Street's calling it a margin floor. We're calling it a supply chain ceiling. What's the one number from today's SMCI teardown that surprised you most? Comment below. This isn't financial advice, it's engineering context. Markets move fast, margins shift faster, and past performance never guarantees future returns. Do your own research before any trade. Hit subscribe for the next teardown. We go deeper than any earnings call. If you want our full breakdown on NVIDIA, the link is in the description. Stay sharp, engineers.